Good morning, everyone. We'll get started. So welcome to the Ortencio Group's Outlook for 2016 webinar. First of all, happy belated New Year. As always, I have with me Gareth Watson, Director of our Investment Management Group at Richardson GMP. Welcome, Gareth.
Good morning.
As a reminder, this webinar is being recorded. Today's presentation, we're going to be discussing the outlook for the Canadian economy and the Canadian markets, along with the rest of the world in 2016. We'll also discuss the ongoing saga of interest rates and what we expect for the upcoming year. Gareth's going to discuss oil, the big elephant, or should we say the big bear in the room, in the Canadian dollar. But before I hand it over to Gareth, I want to quickly go over the performance of the markets around the world in 2015. It was a tough year for the TSX in 2015. It was negative, with a negative performance of negative 11.1%, one of the world's worst performers. The U.S. market was also negative, down 0.7%, just under 1%. MSCI Europe, Australia, Far East Index was down 3.3%. Emerging market was down 17%. The strength of the U.S. dollar versus the Canadian dollar added some solace for investors who may have been fortunate enough to have all their investments in the U.S., in U.S. currency. So for those investors, the S&P 500 was up 18.2%, and MSCI Index was up 15.2%. The reality, though, is that it's probably safe to say that most Canadians did not have all their investments in U.S. currency. Oil continued to slide along with the Canadian dollar. As of December 31st, oil was down 31.3%, down to $36.60. Interest rates in Canada for the 10-year Canadian bonds declined, going from 1.79 to 1.39%. U.S. Treasury went in the opposite direction, though the rates actually rose from 2.17, albeit a small amount, to 2.27. In December, the U.S. Fed finally raised their rates by 25 basis points, or a quarter of a percentage point. The start of 2016, we saw the continued slide of global markets. The catalyst for the volatility has been driven by oil prices. When oil goes down, the global markets follow, and when oil goes up, global markets do the same. And our Canadian dollar also follows suit. The performance as of January 20th, although these are a week ago, but the performance is a little bit better. But the S&P TSX at that time was down almost 9%. The U.S. market was down also, over 9%, and international was down 11.5%. WTI oil prices continued to slide, as I mentioned. Last week it was down to 28.46, which is a 23% decline over that 20-day period. Hence, our Canadian dollar dropped versus the U.S., and then it was a flight to quality as the government bonds continued to decline in rate. 10-year Canadian government down to 1.16, and 10-year Treasury down from 2.27 to 1.98%. Client portfolios fared and are faring much better. Performance ranged anywhere from down half a percentage point to a positive 2%, depending on the asset allocation in 2015. And year to date, we're participating only on part of the decline. The portfolios did exactly what we constructed them to do in this type of environment. This slide shows what we expect from the portfolio that we constructed. When markets are positive, our expectation is to participate or capture part of the positive performance. But the important point to remember is that when markets are down, we expect to participate only in part of the downturn. In my 20 years of experience in managing money for clients, markets are driven to a degree by fundamentals, but in large part by sentiment, or in retail investor terms, fear or greed. At this point, there's a lot of fear in investors. This graph shows the fund flows into mutual funds generally by retail investors. As I mentioned before, to be successful in investing, you're supposed to buy investments at low prices and sell them as the price of those investments go up. As you can see in this graph, risk due to volatility is compounded by investors who actually are buying high, driven by greed or feeling like they've been left out, and then selling those investments at a lower price in fear that they're going to continue to decline in price. You can see in this next graph, that's exactly what investors did during the financial crisis in 2008. They bought high and they sold low out of fear. A report was released that investors are holding record cash in their portfolios. It's been proven that trying to time the market is a futile game. We've created a diversified portfolio for you to ensure that we take advantage of the fear and greed of others. Eventually, all that money in cash will have to be deployed. I now want to transfer it over to hand it over to Gareth to get a sense if that fear is prevalent or is it warranted, or if there are opportunities lurking. Gareth, I'll hand it over to you.
Great, thanks, Frank, and thank you everyone for joining us this morning. I'm hoping to be brief and succinct here in my comments, but also try to cover as much ground as I can here with regards to giving you some type of outlook here for 2016 with respect to not only here markets at home in Canada, but abroad. And we do focus on abroad because what happens in other countries certainly has a direct impact on us here in Canada. So just to touch on a few themes that I'm going to cover in this presentation, we're going to be talking about the divergence in monetary policy that started last year with the Federal Reserve moving in one direction and other central banks either staying pat or cutting rates. We're going to talk a little bit about the United States, obviously a subject of discussion recently about the possibility of a recession coming to the U.S. I'm going to tell you why I don't think that that's in the cards for 2016. We'll be talking about other parts of the world, how Europe and Japan should likely continue to outperform places such as China and the emerging markets. Of course, we'll bring it all on home because we'll talk about Canada. And I'm using the word tricky to describe 2016 for this country from an economic perspective, and then, of course, because of that, from an equity perspective. I use tricky because it's not a word that I think is too negative, but it also can't be too positive because we do face some challenges here. It's just that, it's not that we can't overcome those challenges. It's just obviously going to be a bit difficult for us to do so. And of course, we'll touch a little bit here on commodities. Certainly a driving factor in the market here so far in 2016 with oil prices falling as much as they have. I'll give you a couple of arguments when it comes to the bears and the bulls as to where we're going in the year ahead. So I did just want to touch on global monetary policy. Last year, I noted the Federal Reserve hiked rates for the first time in a very long time. It's obviously off of a very low base, so the impact to the U.S. economy is not huge from that one rate hike, but it did finally signal that the Federal Reserve and the central bank are set on moving interest rate policy higher and taking the United States essentially off of the stimulus life support it's been on now for so many years in the hopes that we can get the U.S. back to a normal state. And of course, everyone has their own definition of what that normal state is, but certainly interest rates as low as they are right now, that is not normal. That can't continue forever. And so we're trying to get back to some sense of normalcy. The question ahead in 2016, of course, though, that the pundits are currently discussing and debating on the TVs and in the newspapers is how many hikes you'll see. Right now, those estimates range from 0 all the way up to 4.
What's your guess, Gareth? And we won't hold you to it.
No, I actually think that considering what's happened so far in the markets this year, some of the slowdown that we've seen in the Asia-Pacific region, namely China, while the United States, of course, does have to focus on what's going on in the United States, they do pay attention to what's going on globally. And there's been a huge shift here for a number of emerging markets, in particular with respect to commodities. They won't be in a rush to raise rates. So for those that are probably targeting maybe 2, I think that's a little bit more in the realistic ballpark. Okay. I think the Federal Reserve is currently expecting 4, but I think those expectations will be ratcheted back a bit. Okay. The United Kingdom, Japan, Europe, all these places, I mean, the UK we thought could potentially move this year. It sounds as though they've backed off of that plan, so you'll probably not see any rate hikes in the UK in 2016. Japan and Europe are likely not to raise rates this year or even next year. It's going to be a while before you see any rate hikes in those 2 regions. And Canada, of course, the debate we had recently, because we had a Bank of Canada meeting, I believe it was last week, where the expectation was that we were going to cut rates. We did not. There's all kinds of arguments as to why this is positive, why it's negative. I'll get into that a little bit more when we get to the Canadian slide. But certainly a rate cut in Canada, I don't know how useful it is, quite frankly, to accomplish any type of stimulus in the economy, especially if the banks don't follow suit and cut their prime rates. And the past 2 rate cuts we had in 2015 were examples where the banks did not follow suit. They only cut their prime rates by 15 basis points instead of 25. It really does defeat the purpose of the rate cut. If you're not passing along lower rates to consumers like you and me, you're not going to get the stimulus that you want. So the Bank of Canada, they have their hands tied in a way because they can do any policy changes they want. If the banks don't play along, then it's certainly not as effective as they'd like it to be. Now, I'm just going to touch on the U.S. first. They are the most important economy in the world. They are certainly our most important trading partner, so we do care a lot about what's going on in the United States. I'm just going to flat out say here the calls for a recession this year, we don't believe them. We don't believe that an economy that's been producing over 200,000 jobs a month for well over 3 years consecutively, or at least on average, I should say, is about to fall into recession. That is not a leading indicator, job growth, for a recession. We actually think consumers are benefiting from the fact that they delevered over the past 7 years and that they have lower oil prices. We know that certainly perhaps in places like North Dakota, they don't like lower oil prices because production's shut down on a lot of facilities and wells in that region. But from a consumption standpoint, it's the same for Canada, admittedly. Western Canada would love to have higher oil prices, but consumers in the East love lower oil prices when we go to the pumps. Unfortunately, some of those savings haven't necessarily been passed along to us yet because of some refining issues in North America. But whatever puts more money in the pockets of consumers is a good thing for the economy. So this is a good thing for the United States. Corporate earnings are still respectable. They're not, the growth rates are not as high as they used to be, namely because a lot of big multinationals have been facing a stronger U.S. dollar. So when they're repatriating a lot of their earnings from all over the world, they're getting less U.S. dollars for them, which just makes it really hard for earnings to grow. Admittedly, we would be more concerned about what's going on in corporate America if earnings growth was slowing due to operational reasons as opposed to currency translation issues. So we're not overly concerned by the fact that the earnings growth rates are not as high simply because the U.S. dollar is stronger. But it is a headwind that corporations will continue to face because the expectation is that the U.S. dollar will remain strong in 2016. And I've touched here with respect to employment data. It is strong. Inflation, we believe, remains under control.
Is it really, just a quick question on that employment data, is it as strong as we're seeing at this point based on how employment is calculated or full employment is calculated?
Well, the only misleading thing about the unemployment rate is that it doesn't incorporate those people that have left the workforce. It only incorporates those people that are out of work but actually actively looking for a job. So there are a number of indicators of employment or unemployment out there. One that incorporates those that are out of the workforce and not looking. Of course, that number is much higher than what we're seeing in the U.S. right now, which is north of the 5% level. However, historically speaking, employment has improved considerably over the past few years in particular. So at least I think the trend is in the right direction. Admittedly, you can look at a whole bunch of different indicators and pick numbers and whatnot, but at least the trend is moving in that correct direction.
So really, for the listeners and the viewers here, we're definitely in a much different situation than 2008 than we are right now in today's world.
Oh, there's no comparison. There's no comparison. This is not 2008. In 2008, we had a complete financial collapse of the financial system of the United States of America. The entire system froze. That is not happening right now, nor do we foresee it happening, especially with rates as low as they are. Banks are continuing to lend to each other, which was not the case in 2008. They continue to lend to consumers, which was definitely not the case in 2008. So just because markets have hit a bit of a rough patch, and there are some concerns perhaps maybe on corporate debt or on certain corporate high-yield bond issues, it is not a reason to assume that the entire financial system in the U.S. is about to shut down, which is what happened in 2008. So I really do think it's like comparing apples and oranges at this stage, and a lot of things have to happen before we can start talking about a repeat of 2008. And for that reason, I don't even think it's worth mentioning at this stage.
Okay, great. Thank you.
Europe and Japan, I'm just going to mention some other parts of the world where we are seeing some, where the trade was generally positive last year and could continue to be positive this year. Not to say that there's huge gains to be made, but there's all kinds of reasons why people still like Europe and Japan, mainly because their interest rate policy is so low, money is cheap, financing costs are low for consumers, financing costs are low for governments in particular. This is why problematic countries can still finance themselves, such as Greece and Italy and Spain and Ireland and Portugal. With that lower interest rate policy comes a weaker currency, which has helped a number of these countries on the trade front, in particular Germany. Germany is an exporting powerhouse, and if Germany had their own currency, it would be considerably stronger than the euro. So they are actually getting the benefit here of having a weaker currency because they have the same currency as a number of other weaker countries. So definitely to the benefit of Germany, and we all care about Germany in the Eurozone because Germany makes up a third of the entire GDP that's produced out of the Eurozone, the 18 countries that use the euro as their currency. If you add in France, it goes up to 50%. If you add in Italy, it's 2/3 of GDP come from those three countries alone. So we care about Germany and how it's doing, and obviously it's benefiting from the weaker euro right now. Certainly a huge benefit, lower energy costs. Europe is a net importer of energy. The former Soviet Union republics, places like Russia and I believe Kazakhstan and Azerbaijan, lots of exports going to Europe. They used to have a lot more political control back when oil prices were high, not so much so now. And then, of course, energy coming up from North Africa into the Mediterranean countries. Naturally, with lower energy prices, it's a lower cost of living and lower cost of inputs for business and industry in Europe, and that obviously helps out GDP considerably. And I will mention here, though, I've just mentioned a lot of particularly positive things that are helping these two areas of the world. But again, this is all policy driven. It's all interest rate driven. It will not last forever. Eventually it will end, but it still remains appealing for now because as we found out over the past 7 years, equity investors love cheap money, love low interest rates, love accommodative policy, and that's definitely what you've got in Europe and Japan and what will definitely remain in place for 2016. Now, on the flip side, those parts of the world that the markets are concerned about, and potentially we believe, that there's some genuine reason for concern, and why, if anything, we would probably be underweighting these parts of the world. China and the emerging markets. I'll touch on the emerging markets first. It's pretty simple. The emerging markets, for the most part, a lot of these countries will either transact in U.S. dollars, they will raise funds, debt, government debt in U.S. dollars, they will peg their currency to U.S. dollars, and this is obviously to help them support themselves because the U.S., simply put, is a stronger economy, therefore has a stronger currency. The problem for them, of course, is that the U.S. dollar has strengthened so much that it is now difficult for them to operate with that stronger currency, whether it's pegged, whether it's the fact that they have U.S. dollar denominated debt and they've got to pay it back. By converting their local currency into U.S. dollars, it becomes much more expensive. And so there is some concern about emerging market debt out there and about the ability of some of these countries to meet their payments going forward with the stronger currency. So there are some headwinds for sure in the emerging markets. When we think about the BRIC countries too, we have to differentiate between those that are commodity producers and those that are commodity consumers. Places like Brazil and Russia right now are struggling. There's no doubt about that. They are in recession, as opposed to a country like India, that is an importer of commodities, a net consumer of commodities, obviously doing a little bit better off on the growth front because they're not relying on exported commodities for their GDP. So certainly a little bit of a mixed bag here in the emerging markets, but overall a place where we would likely be underweight or stay away. And on China, there's so much I could talk about. I really do want to be brief, though, on China to say that we're not really concerned about the Chinese stock market. That doesn't bug us because it really doesn't impact the Canadian stock market or the U.S. stock market. What we care about more is the Chinese economy and the Chinese currency markets, because that offers some disruption to other places around the world. There's more of an influence on the global economy from what happens in China from an economic standpoint. Let's forget about the market. China is in transition, though, and I'm talking about a multi-year, if not multi-decade transition, trying to diversify their economy. They have not become a service-oriented economy overnight. That's going to take many, many years to occur. They're still in the manufacturing space. They are still an exporting powerhouse. It's just not as easy for them anymore because they're no longer the lowest cost producer on the planet. Labor costs have gone up. The cost of doing business has gone up, and that just comes with the growth that China's had for the past 25 years. So there's going to be some growing pains here. It was inevitable that they slow down. They were not going to grow at 14, 13% per year every year for the rest of our lives. We all knew that. The key thing here, though, is that they are able to diversify into other industries and to grow their economy in other areas going forward instead of just relying simply on the exporting market where, of course, they're facing a few headwinds. So China, the outlook for 2016, I wouldn't say is spectacular. I also wouldn't say it's an absolute disaster. So I wouldn't ignore China in the long run, over the next 10 to 20 years, because it's still going to be a place that's going to generate a ton of growth here globally. But in the near term, there are still some challenges that part of the world faces. And so when we bring it on home to Canada, the Canadian economy, we are feeling the pinch of weaker energy. I don't need to explain that to you. You can see it every day in the press. You can, if you have friends out west in Alberta, they're probably telling you about it. In Saskatchewan, maybe out east in Newfoundland, and maybe even to some degree in British Columbia. With that said, we have a private investment hole to fill. And what I mean when I say that is, and to put some numbers behind this, is the Canadian Association of Petroleum Producers forecasts that, or at least concludes that in 2014, the oil and gas industry made about $81 billion worth of investment in the Canadian economy. It was the largest private investment sector in the Canadian economy. The estimates for 2016 fall all the way down to $42 billion. And my suspicion is that was done before oil prices had their recent leg down. Those numbers are probably going to come down further. So you're seeing over the course of 2 years a 50% decline in private investment in this country to the order of $40 billion plus. That's a lot of money that's not going into the economy anymore. So we have to fill those holes. How do you do that? Well, some people will say, look, we have a weaker currency now, so now the manufacturing sector can pick up the pace, industry can outperform, and we can generate some new business from that part of the economy. And that's completely true. I just don't think that the currency and increased manufacturing is going to fill the $40 billion hole in the near term. Currency changes impact the market over the longer term. You don't have a factory that's been shut down at parity automatically reopen as soon as you hit 70 cents. Some of these things take time. You have to convince international businesses to come to our country over time. It's just something that does not happen immediately. So the benefits of the dollar, I don't think we've truly seen a large chunk of that benefit yet to Canada, but something that's going to evolve over the next 1 to 2 years. Because
So you're saying it should work into the system over time?
Exactly. And unfortunately, it's not going to work into the system immediately. And unfortunately, immediately is when we've seen this decline in private investment from the oil and gas sector. So there is going to be a gap. Now then, the other thing that's mentioned, of course, is the fact that we have a new federal government who has committed itself to going into deficit, to making private investment in this country. The deficit during the campaign was estimated to be about $10 billion for the current year. In all likelihood, that will be larger than $10 billion by the sounds of it due to the further decline in oil. But $10 billion compared to $40 billion, there's still a big gap there. So even between a weaker loonie helping out manufacturing and industry and $10 billion bucks, and this is not all going into infrastructure. I mean, a good chunk of it will, but add in that $10 billion from the federal government, and you still probably have a gap in private investment in 2016. So this is why there's increased speculation that the Bank of Canada could cut rates further to try and stimulate on the monetary policy side. Again, I argue that such a cut really won't be particularly effective. So I kind of hope that they don't, to be honest. And the last thing we need right now is for consumers in Canada to add more debt to their personal balance sheets. Some are overextended as it is already. But point being is that we have this gap to fill, and it's not that we can't fill it, it's just that we might not be able to fill it really soon. So I think this is why I'm using the word tricky to describe Canada's economy in 2016, because we kind of face this really big deficit that happened really quickly because of the decline in oil prices and how fast that's occurred. Eventually they can overcome it. It's just going to take, instead of a couple months, maybe a couple years. One of the main factors here, of course, is energy. I won't spend too much time here just to give you an idea of the arguments between the bulls and the bears. Naturally, the bears are winning the argument right now because we're at $30 or sub-$30 oil. The bull arguments are more demand-focused. They're saying, look, over time on this planet, even though we're talking about Paris and environmental accords and using alternative energy, without a doubt, all these emerging markets are still going to use carbon-based fossil fuels in the future, in the next 10 years at least. They don't have the money or the technology to implement alternative energy sources. So China and India and Southeast Asia and the Middle East, Africa, all these places are still going to use oil. That's where the bulk of the population on this planet is. Estimates show that 70% of the Indian population is below the age of 30. This is where a big chunk of the population is and where the big chunk of consumption in oil is going to be. So longer-term demand should increase, and it has. I mean, even though the price of oil has fallen from $100 a barrel, Chinese demand for oil has actually increased over that time. So certainly the argument for the bulls is more demand-focused. The argument for the bears, of course, is supply, that we have too much, inventories are too high. The United States has not cut back enough production. They're still producing at current prices where the Saudis wish that they wouldn't. We've had this nuclear agreement with Iran that's going to bring on more supply over the next, and it's not going to happen overnight, by the way, folks. You don't bring that much oil onto the market the next day. They've got to put some more investment into their system that hasn't been there for the past, well, I don't know, 10, 15 years. That's going to take a couple of years to get it back on. But again, you're adding more supply to an oversupplied market, and that's putting further downward pressure on prices. Now, the difference between the bulls and the bears that I'll point out to you here, because all these arguments on my slide are actually correct, is that the bulls are far more longer-term focused and the bears are much more shorter-term focused. And that's why you're seeing the downward pressure on oil prices that you've seen. Eventually, I do believe there'll have to be some type of bounce in oil because those demand arguments from the bulls are valid. So certainly demand will eventually pick up. I just don't know, of course, the extent to which oil prices will rebound. But I do believe that where we are currently is probably getting a little bit too low. I have no idea where the bottom is. I don't know if anyone knows where the bottom is. But there is going to be some uptick here over the next couple of years in oil simply because increased demand will eat up that extra supply at some point. And commodities in general, 2015 was a pretty bad year for commodities globally. You can see there, of course, crude and natural gas being the second and third worst performers on this chart. I think cocoa and canola were the only commodities that actually went up in 2016 or 2015. Sorry, and when you take into consideration that the TSX has a huge chunk weighted towards materials and energy, this is why you have a stock chart, or I should say an index chart of the TSX, that has headed down in 2015. It's really hard for this index to go up when commodity prices fall. 40% weighted towards materials and energy, add on another 30% to Canadian banks, or I should say financials, which include the banks and the life cos. Not that the banks are in terrible trouble, it's just it's really hard in this economic environment for them to grow earnings, and estimates are for the next year that they grow them in mid-single digits, which is lower than what we've seen in years past. So this is why the Canadian market as a whole is coming under pressure, and why potentially it could underperform the U.S. markets again this year if that downward pressure on commodities continues throughout the year. And finally here, I'll just touch on the Canadian dollar to sum up. Obviously, not a great-looking chart here. The decline recently from, let's say, 78 cents all the way down below 70 has been rapid and I think caught a lot of people off guard how quickly it fell. Most likely a function, again, of energy prices. Most likely a function of the fact we've been talking about further rate cuts in Canada. So what should your expectation be going forward for the Canadian dollar? I'm going to say 70 cents on average for the year. And I usually don't even like to go out beyond 6 months, quite frankly, with currency forecasts because there's just way too many moving parts that go into those forecasts to be really that correct for an entire 12-month period. But I say 70 cents for a couple reasons. And I know after the recent fall, there's been some calling for 59, 58 cents. I think that's a little bit of fear-mongering. With the U.S. economy doing as well as it is, relatively speaking, and the fact that eventually we will see some benefit into the Canadian economy from that lower loonie, I don't see the loonie falling on a more permanent basis down towards the 60-cent level. Now, where could I be wrong? What could happen that would push the loonie down to those levels on a more sustainable basis? Number one, oil prices have to really fall a lot further. So those forecasts out there of $20 to $15 for 2016 have to be correct. I don't think that they will be. Number two, the Bank of Canada cuts interest rates all the way down to 0. I don't think that they want to do it. Certainly if they did want to do it, they would have done it last week. They're trying to avoid it if they can. They're waiting for the budget to see what they're going to do. Hopefully they like what they see and they just hold pat on rates. If they do go down to 0, then certainly this loonie can fall further. And then just a huge pickup in U.S. dollar strength. I mean, if the U.S. economy really takes off while our struggles, which usually doesn't happen that often, quite frankly, because we're so connected in many ways, that can have obviously adverse effects because of flight to quality. People getting nervous about the markets, putting all their money into U.S. dollar treasury, that bids up the dollar and pushes down every other currency. These are scenarios where it could definitely fall further, where I could be wrong. But on the whole, I think that this most recent decline has been so rapid that we do have to kind of find some level of stability in around the 70-cent level. So that means, 67 to 70 cents. I think that's a realistic expectation, at least for the next 6 months. I wouldn't go as far as the year, but if you need a whole year average, I would probably use the 70-cent level. Bottom line here is that it's not going to rebound considerably. We would need a big increase in oil prices to do that, and I don't necessarily see that in the next 12 months. So those are just at least setting expectations. If you run an exporting business, you've loved what I've just said. If you love to cross-border shop and vacation in the United States, you did not like what I just said. But that's the reality of the situation right now with the dollar. So I'm going to sum up there and pass it back over to Frank.
Okay, thank you, Gareth. So in summary, what you've covered and stated is that China at this point is an issue, but it's not that big of an issue. It's really about growing pains for them. We should expect to avoid a recession in the U.S. We should expect maybe 2 rate increases in the U.S. and possibly a rate cut, in Canada, but may not be as effective as they anticipate. And I think the most important part is that this is not 2008. So thanks again, Gareth. I want to reiterate that the philosophy of our team and our approach to diversification and disciplined investments have again proven to be the key to success of your portfolio versus the broad benchmarks when it comes to these types of environments. So to everyone listening here, I want to thank you for entrusting us, your attention. We do not take your trust lightly. Thank you, and we'll talk to everybody soon.